Hello, everybody. Today I'm here with our guest, Bogumil Baranowski, founding partner of Stikard Associates and the author of three best-selling books: Crisis Investing, Money, Life, Family, and Outsmarting the Crowd. He also runs the podcast Talking Billions, where he interviews many wonderful guests in this value investing field, and do check that out too. Without further ado, let's head right into the discussion.
Well, hello. Thank you for having me. I was really looking forward to this conversation. And yeah, I'm excited to be here today with you.
Yeah. Um, so so just to start, I would like to ask you about your childhood, how you grew up, especially because you grew up on the Eastern Bloc of post World War II Europe, so the wrong side of the Iron Curtain, as you mentioned before. Yep. And in Poland, and then you went bargain hunting with your grandmother, which eventually led you to Buffett, who's known as the Woodstock of capitalism and capitalists, and Graham, and then buying good businesses during times when no one believes in them. So, how did your childhood bring you there?
Now, it's a wonderful and big question. So I was born in Poland, and then I went to schools around Europe. And I picked up a book, One Up on Wall Street by Peter Lynch, which is a book that I know that you like a lot. So I'm curious about what you thought of the book. But I was curious about history. I was curious about numbers, and I was studying economics and finance, but I couldn't really put it all together. I wasn't sure where it will lead me. And it was the time soon after the internet bubble burst. So a lot of my professors were not really encouraging us to go to investing. They were talking about the stock market as if it was a casino. And I think it can be if you want it to be, but it doesn't have to be. And Peter Lynch had some very clear ideas in the book that really spoke to me. And the biggest one was that stocks are small pieces of businesses. And I never thought of the stock market as a place where I can go and buy small pieces of businesses. And it doesn't really matter if you have billions of dollars of or hundreds of dollars, you can become a shareholder along with Warren Buffett and Bill Gates and everybody else. And it really spoke to me that you have an existing business that's successful, that has products and customers and profits, and you get to own a small piece of it just like anybody else. So from that point on, I couldn't look at the stock market the same way. And I continued to read more books and discover more greats, as you call them in your book, Worldly Wisdom, which is coming out soon, I hope. And I continued to learn, and I discovered Warren Buffett. Actually, Peter Lynch mentions Warren Buffett in One Up on Wall Street, but I have to tell you that when I was reading those pages, I had no idea who Warren Buffett was. If anything, I knew there was some successful business operator out there, but I had no context of what a wonderful investor he is and what a long record he already had at the time. It was the early 2000s. So that's how my journey took a turn and led me to New York. But you asked about childhood, and it's an interesting topic. And I, as you know, I ask my guests on my podcast, Talking Billions, about their childhood and upbringing, because I think interesting things happen in those early years, and we get shaped in a certain way, whether we are talking about risk aversion or how we look for opportunities and how we think of wealth, money, and investing in general. And in those conversations, I discover that you can trace back some of the habits, the rituals, the routines, the principles that you have to some early experiences. In my case, I remember shopping for groceries with my grandma. And I don't know if she knew, but she was a very conscious value shopper. And she knew that there's a price and there's a value of whatever it is that you're trying to buy. And watching her find value and not overpaying for it stayed with me. So when I was reading about Benjamin Graham and Warren Buffett and Charlie Munger and Sir John Templeton and everybody else that followed, I realized that the concepts are very straightforward and simple. It doesn't mean that they're easy to deploy, but they're very simple. And you could shop for businesses the same way. So combining the idea that Peter Lynch had that you get to buy small pieces of businesses, but then think also about what kind of price are you willing to pay? So I'm always curious to find out why do I do what I do. And some of those principles were established very early on, as you mentioned in my particular experience. The big thing about what happened in Poland in the early decades of my life was that the first decade of my life, which was the 1980s, Poland was part of the Soviet bloc, which meant that there was no free market economy. The government owned pretty much all businesses. So you had to be an employee of a state owned company. And think about it for a second, but if you did something that the government didn't like and they were the only employer in the country, that's not a very comfortable place to
Yeah,
be. And the system was so inefficient that it led to major shortages, at least in the state government owned stores. So I remember stores being half empty. But then there was a gray or a black market in groceries and food products and other items. So you could buy them outside of the official stores. So the economy functioned not in a perfect way and not in a complete full way, but it functioned. And it made me realize that certain things that are very natural to all of us, like offering your services to goods to other people. That's how the economy works. When you put laws and rules that say you can't do it, by definition, you will make people frustrated and unhappy, and that will lead to shortages. But then in 1990, around that time, a massive change happened. Poland reopened, the free market economy got restarted, the stock market reopened after half a century, and I got to see a massive change. And I think it took me another decade or two and a couple more degrees to really make sense of what happened. A massive economic miracle. But I was about your age when the stock market was just reopening in Poland, and there were quite a few stocks that were listed, but not too many. I want to say maybe less than 10 at some point. Major banks, major insurance companies. And before this conversation, I was thinking about me when I was your age, and I would write down the names of the companies in a little notebook, and I would write down prices every week. And I was trying to see, is there a way for me to guess where those prices will go? And then I slowly lost interest because the stock market was so small. So I only rekindled that interest down the road with Peter Lynch and other books that I read. But I remember that very new nascent stock market with a lot of ups and downs and quick bull markets and big crashes, but with very few stocks. So it's something that stayed with me because this stock market reminded me of the 1800s US market where you had the railroads and not that many securities traded and quite a bit of volatility. So it was a fascinating time, and I think it shaped me in many ways. And I continue to make sense of those years, and I think it has helped me on my path as an investor as well. And I trace back a lot of the ideas that I deploy these days and mindsets to those early days.
yeah. That's really interesting. I mean, when it comes to One Up on Wall Street, I think it was the first book I read when I was learning about stock market and value investing and all. So it has I think a special place for me, and also I think I got to learn a lot of the basic fundamentals that if I luckily my first book was that and not a book related to trading or a book related to you know momentum investing, etc. So I think it really
How did
shaped the way.
how did you come across that book? Somebody recommended it to you?
It was actually the only book in our house that was investing related. So yeah, so my dad actually bought it when he was younger for himself to read, but he ended up leaving it. I think after he read half of the book because he realized that maybe it value investing is not his cup of tea, and um, but he then asked me to read it, and I think and told me that it's a good book if I want to start out. And then I read One Up on Wall Street, and I got to I think it really shaped the basic that a stock is essentially an ownership in a business, and that over the long run, if you buy a great business, then that stock will follow the path of the business instead of, you having to be on the screen all the time, trading, looking at prices go up and down. So yeah, I think that shaped me a lot as well.
How old were you when you read that book?
I think I read it in 2019, late 2019. So I was 12, I think. I was 12 years old. Yeah. But I think it's
I
a pretty
reread that.
yeah, I think it's a pretty
Go ahead.
uh pretty easy book to read for a beginner because Peter Lynch
Hmm.
doesn't overcomplicate it. He just talks about his life's experiences, his examples of dealing businesses. So that made it simpler, I think. Yeah.
To me, also, the big message from the book is that we all can do it. I gave a TEDx talk a few years ago about a great investor in you, and I quote Peter Lynch among others. The idea that all of us could and possibly should be investors and benefit from the success of businesses out there. And I think what gets lost, people talk about outperformance, about becoming the richest person in the world, but that really is not the goal here. The goal is to make use of the capital that you continue to accumulate throughout your lifetime. So you continue to save, which is one of the first principles you can think of. And then if that money is deployed in a productive way by businesses you get to invest in through the stock market over the long run, that amount will continue to grow and possibly help you in life or give you options or offer you certain freedoms that you wouldn't have had you not had that kind of nest egg growing. And I think the beauty of investing over a lifetime is that you can continue to learn and the mistakes are relatively small. We manage money for families. So we are in a slightly different position. And I talk about a lifetime of contributions and a lifetime of distributions in some of my articles. And the kind of investing that you and I are talking about right now, where you put a little bit of money over time, over 10, 20, 30, 40 years, each individual contribution, you don't have to be so focused on if it's a bull market or a bear market. It will all even out over time. And if you want to make it in a very passive way, you can invest in a broadly diversified index and participate in the success of the global economy or the US economy or whichever economy you feel closely associated with. And then over time, there are some huge benefits to being a lifelong investor. Now, then, the lifetime of distributions is a position that we're put in where there was a moment of, I would call it sudden wealth, whether inherited or through a big pay through work in a big tech company or a successful sale of a business. And you start with a large capital up front, and you immediately have to know how to deploy it without taking certain risks and focusing on certain opportunities that make sense. So it's a mindset of staying rich, and you have less time or no time to learn and make mistakes. And that's where we come in, and that's where we can help with the experience we've had managing family fortunes over decades. But it's a slightly different and much more demanding position to be in because you don't have decades of small contributions to learn with. Just a food for thought when people think of contributions and distributions and a lifetime of building wealth or keeping and growing the wealth that you already have.
Yeah. I think the only rule about value investing is to not lose money, as I think
Mm-hmm.
Buffett said it before. And I think our entire aim is to not buy bad businesses. Um, and over time, I think that does, I think, wonders. When you think about, how money can also compound. It's not linear.
Mm.
It will increase as your time increases. Um, so
It's
with that,
Go ahead, but I was going to add that it's a very powerful idea that the capital that we manage is the capital that our clients don't immediately need, which allows us to invest for the long run. But it's also the capital they can't afford to lose. And what you mentioned, rule number one, not to lose money, I think it's a very powerful idea. And a lot of people go into investing with the focus on how much can I make. but I think it's very helpful to think for a second, what would happen if you lost what you're putting at risk right now? And what would be the consequences? Just so that you have the right, not even risk aversion, but more of a risk awareness. What if I lost it?
Yeah. And I think it's not about the volatility or the the just the
Mm-hmm.
movement of the stock going up and down rapidly. Rather, I think the idea of risk should always be the idea of losing capital or losing money that's important because if you one bad investment can I think ruin the entire sort of nature of compounding if you really deployed a large amount of capital into that investment. So I think we do have to be careful in that sense to, I think, conserve capital. I think the entire aim is to conserve it and to grow it so that you can fight with the fact that there's always inflation going on, um, bad economic conditions. So, yeah. um,
I agree.
so, yeah. So, my second question is, since you run your own podcast, and I think you've interviewed, I think lots and lots of guests, and a lot of them have really, really interesting backgrounds. They have really, really interesting stories, answers. So, from all these different individuals, what are some of the answers that you got, or some things that you learned from them that surprised you the most, or with these people that you have talked to?
No, it's a fantastic question. So the idea for a podcast, I write articles, as you know, and I wrote books, and it's one way of, for me, collecting my own thoughts and organizing them, and then also remembering what I thought at a given point in time, especially in terms of articles. So the Crisis Investing book that you mentioned is a collection of essays that I wrote throughout the COVID pandemic. But then I realized that there is another way to share ideas, and the podcasting world, I think, is going through some sort of a golden age right now on both sides. I think there are quite a few listeners that are really passionate, and I see in my own statistics how people listen to the end of the episodes, which I'm both grateful for, and I admire that somebody has an hour and a half of their day committed to me and my guest. So I thank everybody for that. But I think something really special happens when you sit down with somebody and have a conversation. And I try to make sure as much as I can that it's a conversation between friends, and we kind of forget that somebody else is listening. And I think it creates this very intimate moment where for an hour you have somebody's full attention. And these are authors and successful investors and people that I know, or the people that I knew of, and I had a chance to meet them in person. Quite a few people that have been on the podcast, out of almost 50 right now, I met in person, and it's really fun to have them for an hour and go so deep and get to know them from a different perspective. Some of them I followed their newsletter for years, or I read all the books they published, but actually to sit down and say, what did you think when you said that, and go a little bit deeper. But your question is, what are the big takeaways? And I notice how people from very different backgrounds and very different parts of the world have come up with the same principles that you and I started touching on in this conversation. It comes from saving, the benefits of investing. So the principles, you could say that they're a secret, but they are not really until somebody discovers them. So the fact that stocks are small pieces of businesses, it's one of the big ideas. But once you discover it for yourself, you realize many people know that. So as an investor, you keep on looking for an advantage. What is it that I can do that nobody else can do or doesn't do as well as I would do? And I like to say that I'm not smarter or faster than anybody else. I don't think I can process information quicker than many of the geniuses out there that have the same access that I do. So I kept on looking for what is it that I can really do that fewer people choose to do. Maybe they could do it, but they don't choose to do it. And patience and discipline is a big part of it, that I'm willing to wait. So when we buy a stake in a company, we're really willing to wait 3, 5, sometimes more years. And a lot of people say they're long-term investors, but when you actually look at their actions, there are not as many people that are truly long-term investors. So the patience, the other big piece of it, and I had quite a few people that are focusing on behavioral finance. I had a neuroscientist, Lucas Miller, on the show. I had Daniel Crosby, who studies the psychology of wealth and markets and has fascinating observations about it. How what we can do is we can find other ways that can create opportunities for us. And I like what Daniel Crosby told me. He said when people think of behavioral finance, they see this as a window that you look through and you say, oh, of course, my neighbor would make this mistake. Oh, my sibling would do that, but I wouldn't. And he says, for a second, when you think about those biases that we have, look at what I write, he says, as a mirror, and realize that if you're really honest with yourself, we're all humans. So we will make those mistakes. What is it that you can do to make fewer of those? Or if you make them, make sure that they're as small as possible so they don't really hurt you in terms of the losses that you mentioned earlier. And I personally do a couple of things to make my life easier. So, for example, a daily quote. You talked about volatility. The stock market gives you a different price every moment of the day. And no matter how disciplined and patient you are, it erodes something in you. And eventually you might give in and sell or buy for the wrong reason. So if you can limit your exposure to a daily price quote, I think that's very helpful. Then there's a big part about news. And I know that you're curious about it as well. Everybody writes these days, and everybody has an opinion out there online these days. There's an unlimited amount of not really data. Sometimes it's just noise. So you have to filter out a lot of that because it will also erode any commitment and conviction that you had to any investment idea, because you'll find somebody that doesn't like what you like. So building out those filters helps. But the last building block, the third one, would be the right environment that you create for yourself as an investor. And here I mean anything from a space in your house or in your office, all the way to even choosing a city or part of the world that you operate in. And when you think of Warren Buffett wanted to be in New York, wanted to be close to Ben Graham. He studied with him, but then he wanted to come back to New York to work with Ben Graham, which he did. But look what happened right after, and he was still in his 20s. He ended up going to Omaha, and I know you've been to Omaha. Omaha is a quiet city today. Can you imagine what Omaha was like in the 1950s?
Yeah, yeah. It's really, really quiet even now. So
So this was before, obviously, the internet and well, there were phone lines and information also moved around, but it was a very different pace of life. But I think it helped him quite a bit to get more focused and not distracted by a big city. And look at Sir John Templeton, who moved from New York to the Bahamas. Look at Guy Spear, that I think you met as well, who moved from New York to Zurich, which is also a fairly quiet town, very organized, very structured. So I think being honest with yourself and realizing what kind of environment, all the way from your desk to where you choose to live and operate, how that influences you and creates a better environment for you to prosper over the long run. I spent most of my adult life in New York, and it's a wonderful city. I love New York, and I would go to lunches, events, and meetings, and I think I learned a lot through that experience. But I also realized that there's a moment where it's easy to get lost and not know what you yourself independently really think, and what's your opinion about something, because you get to hear so many opinions. I wrote a piece that I called Selective Ignorance, and I gave a talk in Zurich this summer, and it was one of the points I raised, and it really resonated with people much more than I expected. And it's the idea of choosing to completely ignore big parts of the market and big parts of the news world that don't serve you. And I share a story how when Bitcoin was having a hard time, and Sam Friedman Bankman, whichever way, I forget his name, SBF, SFB. Anyways, people were texting me with FTC and SBF shortcuts and telling me, "Are you watching this?" And I didn't know what FTC was and who Sam was. I was completely ignorant when it came to the crypto and Bitcoin world. And I'm curious about the blockchain technology behind it, but I feel like we got kind of lost interest in it and we got so obsessed with the currency. But anyways, at that point, I chose not to pay attention to that part of the world at all, to the point that I didn't know the names or the tickers or the names of the companies. And when people mentioned those names to me, I had no idea what they're talking about. So I got to the point where I choose not to pay attention to certain things because I feel like there's only that much mental and brain capacity available to us, and we have to choose how we use it. I had a neuroscientist from UC Berkeley on the show, Lucas Miller, and I highly recommend his episode. He's a really thoughtful guy. I actually met him in Switzerland, and he told me something that really spoke to me, that our brains obviously are not wired for the world we live in, but also our brains are built for survival. So they continuously scan the environment around us. And when I say the environment, I don't just mean physical, but your phone is a window to a much bigger environment, right? You would never know before that there was a fire on the other side of the planet. Now you do within seconds, and there are pictures and videos. It's very stimulating and sometimes very disturbing as well. So the way I interpret what Lucas told me is that you have that battery of mental power and your brain is ready to be poked. People passing behind you when you're sitting in a cubicle in an office environment, which you haven't experienced yet, and maybe you don't have to be in a cubicle in your lifetime, you can work remotely. But if you do and you have somebody walking past you and you think, I don't care, it doesn't matter, your brain acknowledges that somebody was walking behind you, and your train of thought gets disturbed in that moment, and you can't continue working with the same capacity that you had a moment before. He also talks about the presence of a phone next to you. If you have a phone even face down next to you, and they do tests and research, they show that you're not running at 100% of your abilities. So if you can use all those little, but not so little, tricks and advice and insights, you can realize, how can I use my brain to its best ability, and be kind to your own brain and your body so that it serves you well on your investor or whatever path you choose to have, because quite a few of us will continue to use our brains in our careers. So all kinds of lessons and observations. But what I'm learning is, one thing is to know the principles, and I'm sure you're discovering, writing your book, Worldly Wisdom, that one thing is to know the principles, and the second thing is to make them part of you, make them part of your mindset, your philosophy. And that's the second part is the hardest. And especially it's hard in moments of distress. We're all disciplined value investors until March of 2020 happens and the market loses 30% in a couple of weeks. Then fewer of us are as disciplined as we promised to be.
Yeah, that's very, very true actually. Because the way I started out with at least in the analyzing businesses and look at, I think I had a blog, and over there was like market crashed, and then right after the COVID crash, I think there were so many SPACs, so many IPOs that were happening, and I was just like thinking every one of this is good, but it's not. Good companies. A lot of them are really, really bad companies, and I think we mistaken them because at those points in time, it's all about the greed. It's all about the fact that everyone's making easy money. Let me jump on as well, and just enjoy the ride. But I think uh, it's I think as I wrote in my book, or as Buffett also said, it's when you're doing these kind of things, you're being like Cinderella, but you're playing in an era now where the clocks don't have any hands, so you don't know at all when it's gonna end, when it's gonna hit noon
Mm-hmm.
before the party ends. Yeah, so I think that
Have you
just really resonates with me as well.
have you lost money on your very first stock investment?
So actually, I made on my first few investments, I made lots of money because after the crash, we were recovering. So it wasn't good businesses. It was just, easy sort of money. But then after that, when I continued doing that, I think I lost all of the gains that I made previously.
Mhm.
Uh, because they were really bad companies. And then, luckily I sold after I lost, I broke even. But if you look at them now, I think a lot of them are horrible. They're drowning in debt. They're and I feel really, in a way, uh, humble and also stupid for, jumping in on these companies when they were so bad, um, you know, qualitatively and quantitatively. So I think right after I realized that all the stuff that I made had evaporated, I
Mhm.
think in a couple of months I realized that this is probably not the right way investing works, and then this is not how to continue. So I had to change, I had to adapt, and I had to also learn from I think Buffet and Monroe. So for I think a year and a half, I'm like, okay, I'm not gonna learn about the market at all. I'm just going to focus about value investing, learn its core, its basics, its fundamentals, because I think once you have the right fundamentals, after that you can apply. And now I'm like, if I see such a company, I'm like, nah, it's a straight no. So I think that's it's good
You,
because I got an opportunity to learn. Yeah.
I think we underestimate how much we can learn from mistakes. And obviously, we remember our own mistakes the best. It just works that way, at least for me. Now, they're the most expensive because they cost not just money, but also time. But if you can learn from other people's mistakes, which is easier said than done, it's hugely beneficial. And even if you look at very successful investors, Warren Buffett jokingly says so many times how they made so many mistakes. And just look at the decisions he made and look that because the losses were not as big and not as meaningful, he could continue to go and make money in other investments. It might have slowed him down or he still thinks about them. But if you can study the mistakes of the greats, I think can help you a lot. You'll notice when you did your research for your Worldly Wisdom book that there are more books about successes than failures. And there are quite a few. If you actually search for a book that has the word failure in it, I don't know if they don't sell. I would be a buyer. But people are less willing to talk about failures. And as the idea of a survival bias, even if you look at funds or investors, you just see the ones that are still around, which is a great sign that they've been around for a long time. And the businesses that we see on the stock exchange. So when you look at it as a funnel of all the venture capital, all the ideas that were created, some of them disappeared. I think some of them are disappearing as we speak because I think funding for newer ideas has been less available than it was during the SPAC era that you mentioned in 2021. But when you look at the funnel and you look at even the S&P 500, these companies have proven themselves time after time over a long period of time. So they're just the tip of a very big mountain with a lot of companies that have never made it that far. They never actually proven that they have a real business, a sustainable business, a business that they can defend. And I think to me, the big part of it is what is it that we actually buy when we buy a stock and we buy, and people, a lot of people know it, but for those that don't, you're buying profits, you're buying cash flows. That's the only reason to own a business. So when you think of it this way, whether it's a small business that's not on the stock exchange, of a privately owned laundromat that has a limited upside in terms of how big it can get, all the way to owning Amazon or Apple or Google or Berkshire Hathaway, the concept is the same. You're trying to see how much in profits this business can generate, for how long can it grow, how sustainable it is, and how much am I willing to pay for it? And that's as simple as it sounds, but as hard to do as it can be.
Yeah, I think learning from your mistakes is pretty easy if you're able to identify and accept that I made these mistakes. But when it comes to, I think, other people's mistakes, we tend to overlook them. We don't really care, and that's for a good reason because we have our own things to do. But I think we should be noticing people's mistakes, and I think when it comes to businesses, I think we should be willing to own businesses that make mistakes, but that makes small mistakes so that they don't ruin themselves. They have the ability to continuously make, I think, small mistakes, and then once in a while, when you get a really really good um, you know uh, decision among those bad ones, I think that play out really well. So while we are on the topic of mistakes, so another question I had was because you stay away from, I think you mentioned in previous podcasts and previous, I think in your blogs as well, that the three things that you mainly stay away from are businesses with bad management, businesses that use leverage or debt, and then businesses that are in an industry or companies that are basically in secular decline.
Hmm.
So, are there any other warning signs that repel you away from the company? And my follow-up question to that is, so what were your biggest mistakes